Hello everybody, it's Tom Sheridan and Ben Kumar here to talk about the 7IM views on the back of our Q2 2018 asset allocation discussions. Now we've taken a little bit of feedback from you over the last couple of quarters, and what you've told us is that the videos have gone on a little bit long. And more than that, you said some of us wanted to know about what the world macro picture was, and some of us wanted to know what was the detail of the portfolios. So we're going to divide that into two separate videos. This one will be the market views, the world market views video. Now, what are the kind of things that we might headline when talking about global economics at the moment?
So things to think about from a global economics point of view always are growth and inflation. And in this environment, you need to think about central banks too.
So that little old thing called QE, that's not so little.
Yeah.
Let's start with growth, and let's start with my fellow Americans over there and what the Trump and the crowd are up to.
So your fellow Americans on their own are getting on pretty well. Growth at around 2.5%, unemployment pretty low. Things are looking quite good in the US. And from nowhere, Donald Trump gives them a shot in the arm. The fiscal stimulus, the tax cuts that have been proposed are worth about $1.5 trillion, which is going to be about 1% extra growth on GDP this year and in 2019.
So the US is growing at about 3% these days, is it?
That's what we think will happen in 2018.
With perhaps an unnecessary shot in the arm, but more on that later. Europe.
So Europe, which let's not forget, is 22% of the world economy. Europe is a big deal, and it is having maybe not the time of its life, but close to it. Growth at 2.5% is about as good as it gets for the Eurozone, and it's coming from more than one place, not just relying on Germany anymore, but places like Ireland growing at around 7%, Portugal, Spain, Italy, even Greece is growing now. Everyone in Europe is starting to pull their weight.
So the US, courtesy of a big tax cut on an already hot economy, 25% of the world GDP doing fine. Europe, another 22%, also doing well, better than it has done in a decade. China has been trying to slow things down a little bit. Are they being successful?
It has. China's 16% of world GDP, and they are trying to slow growth down, but they're not trying to stop growth. They're growing at around 6.5%, and that's where they want to stay. So 6.5% is still a pretty high growth number. No developed economy has seen a figure like that for a long, long time.
The UK, although it's only about 4% of global GDP, very important to us and to our clients. What's the read here?
So in the UK, we pay a lot of attention to the impact of Brexit and that it might slow down growth. It may well. Estimates are 2% for UK GDP in 2018. That's still pretty good. It's not quite as good as the rest of the world, but that's only because things are going so well elsewhere. UK at 2%, I think we'd be happy with that.
So I'm going to one more try at trying to find a bad spot in the world. Right? Japan for the last 3 decades has been the deflationary story. Is it now?
It is not. You don't get it right that time either. Japan is growing, and it's not spectacular. It's 1.5%, which for everywhere else would be a little bit uninteresting. In Japan, it is fantastic. It's what the government's been trying to do for the last 8 years, get this kind of growth going. So even Japan is now growing.
So Ben, with all this wonderful news that we see on the economic front, investors like ourselves and our clients must be euphoric. Is that the case?
No. We're a little bit concerned about a couple of things. Central banks and the outlook for inflation.
So let's start with the central banks. That's quantitative easing and interest rates, basically, yeah?
Absolutely. The thing with quantitative easing is that since the global financial crisis, central banks have pumped about $12 trillion into the world economy. You can see on the screen how important that's been. As those assets have risen, equity markets have risen, and bond markets have risen as well. What we're worried about is what happens when those $12 trillion start getting smaller.
And as we've seen in the beginning of 2018, markets have been a little less sanguine, and probably because markets are worried about inflation. Should they be worried about inflation?
Markets shouldn't be too concerned about inflation going into runaway territory, because there are still quite a lot of deflationary pressures out there in the world.
Such as?
Demographics. Baby boomers are retiring. That brings prices down. Technology. Things are getting cheaper over and over again, keeping prices low. And finally, globalization. Trade last year grew at 11% around the world.
So notwithstanding the trade war rhetoric that we see in the papers, that appears to be, in terms of the numbers, a bit of a sideshow at this point in time.
Absolutely right.
So where does that leave us in terms of our base case and our fundamental views on what to do?
Our base case is that some inflation will come through, so you will see some interest rate rises from central banks, but they will be gradual and they will be controlled, which means bond yields are likely to rise, but hopefully in a gentle, again, controlled manner.
And equities, we're looking for equities to continue to rise, but in a much more volatile fashion, and that probably means we're going to have to buy some portfolio protection along the way.
Absolutely right. Global growth, as we said at the start, is fantastic, which is good news for the equity markets. But the journey might be a little bit bumpier, so we're going to do what we can to smooth that for clients. So even if it means missing a bit of the upside, we'll make sure that we do well when it gets a bit nasty.
Ben, thank you very much for that. And for those of you who would like to see particularly what that looks like in the portfolios, I would refer you to the portfolio positioning video that we've produced. Thank you very much for your attention.